Payment Protection Insurance, or PPI, is not a bad product in principle. It's designed to cover loan, finance or credit card payments in case you are made redundant or are too sick to work. PPI can be acquired relatively cheaply when purchased as a standalone product. However, banks and other large financial organisations saw an opportunity to link PPI to loans and credit cards. Heavy selling techniques were adopted and premiums soared, along with profits. Since the mid-1990s, mis-selling of PPI has been rife across the financial services sector. Most major lending institutions were guilty of jumping on the PPI bandwagon. The most common mis-selling practices included failing to inform customers that PPI was optional, or leading them to believe that it was compulsory. Other practices included failing to discuss the price of the policy separately to the loan itself, the overall cost of the policy instead of just the monthly premium, the cooling off period, and, in the case of single premium PPI, the lack of pro rata refunds or payment of interest. Many banks and lenders generally failed to explain the policy in a way that was understandable to the particular customer. They also frequently failed to investigate whether the policy was suitable for the customer's needs. Consequently, PPI was sold to customers for whom it was unsuitable. For example, self-employed or retired people, or those with a medical condition who would be ineligible to claim. The FSA laid down guidelines for lenders to compensate customers who were mis-sold PPI. The banks withdrew their initial legal challenge to these measures, paving the way for thousands of PPI reclaims. If your bank or lender was guilty of any mis-selling practices, you may be entitled to a full refund. For more information on PPI refunds, contact the Claims Connection managed by Winston Solicitors LLP on 0845 009 6899 or visit the Claims Connection website.